prices. Is that going to really come into the stock action as a theme?
Well, I think that part of the decision the UK voted to leave the EU was a follow-on from that. I mean, the London economy is the London economy. It behaves very differently from the rest of the country, but you go 50 miles outside of London, away from the cities, you get into relatively poor countryside, and the gap between the average income there and the average income here is huge. And I think that has manifested itself in the way people originally voted. Rightly or wrongly, they perceive that they're worse off than they were 10 years ago, and I think that's fair enough.
I think you're right. Can we go into your overweight on equities and commodities? Simple question, where?
Well, fundamentally, I look at global growth at 3.5, 3.6, which is about trend. And I look at, and yes, it's decelerating, but not at a huge space. I think the trade war, if you call it a war, will work its way through the system faster than what the market is discounting. So I think it's still a good environment to be long risk assets, primarily because I'm worried about bonds. I've always been worried about bonds because the sheer volume of issuance, primarily in the corporate sector, which is now starting to sell off, spreads are widening. The whole world tends to focus on the tip of the iceberg, which is the 10-year US Treasury. The reality of it is most of the damage will be done under the water, meaning the losses in bond portfolios will be accruing not from US Treasury or government exposure. It's in the corporate space where this debt needs to be rolled over. So why do I like equities? Primarily because I really don't like bonds.
Yeah.
And even though global growth is slowing, it's still at trend
Then I've
level.
asked you the wrong question. I should start off on your comments about the bond bubble bursting, because you don't dislike bonds because you like equities. You like equities because you dislike bonds. So let me start off with the root then. Why is the bond bubble bursting?
There's a lot of debt that needs to be refinanced, and probably most importantly is that we're only at half time in the QE trade. Central banks have bought 14 trillion worth of securities that they're either going to sell, hold to maturity, but not repurchase. That eventually has to mathematically lift the clearing rate for bond rates everywhere on the yield curve.
Because we've seen the abating of purchases a long time ago in the US, and we're now seeing the abating of asset purchases in the Eurozone as well, why can't we see a resumption of that and an increase in the size of the balance sheet? Why can't that just be picked up yet again for QEs 4, 5 and 6?
We certainly could, but the central banks, I think the US is in good shape because they've been hiking for 2 years. They have some ammunition to fight with. There's a limit to the amount of bonds the ECB can buy because they're running out of bonds to purchase, and interest rates are still negative. I mean, the euro is in a precarious place if growth slows from this level because they're running out of ammunition.
I think we can get there. We can get to QE perpetuity here, but to get there, growth assets will have to depreciate a lot more, and that's my fear, and that's the way I feel about European equities. I mean, kind of challenging your view. I agree with you that central bank balance sheet efforts, they're actually going into negative space. So there will be no G10 central bank balance sheet effort going into Q1 next year. And this is actually pretty dreadful for the fixed income side. But by the same token, we are, pretty much going into the deceleration. We don't know the magnitude of that. But even the ECB is acknowledging the fact that the economy is decelerating. So it makes me very uncomfortable holding growth risk in Europe, and that's a conundrum, and and that makes the life of investors very difficult.
Where's the pressure point going to be, though? Because yesterday you saw Ireland and Portugal yields move higher after the ECB, but not Italy, and Italy has been the clear and present danger for a lot of investors. Is that the right trade? We're going to start to see yields push higher on the periphery, but not necessarily on the stories we know about, like Italy?
Well, maybe it's been the story of this year where you thought there'd be underperformance, you've not seen it. It's very hard to trade the peripheral spreads because they're so country specific, and a lot of the flow is owned by domestic banks. I mean, the Italian banking system owns an awful lot of their domestic debt. So it behaves very differently than say, Portugal or Spain.
In terms of where one will find the happiest hunting ground on the bond bubble bursting as well, I mean, you can look at everything from high yield to investment grade and take those descriptions with a pinch of salt, because high yield isn't high yield. Very often investment grade is teetering on the non-investment grade as well. So, and obviously the defensive qualities of these bonds as well also being called into question. Where is the most obvious place where the tension is and actually you expect perhaps it to break first and make the biggest gains?
Tension.
I mean, is it in the corporate bond space, or do you want to look at the sovereign space?
I think you look at the BBB sector of the investment grade. You know, that as a percentage, I think, of the investment grade world is in the 27, 28%, something like that, against a normal average of around 10. You know, it doesn't take much of a slowdown in growth to start the downgrades coming through, and then these things are dropping out of the investment grade sector into high yield, and it's a different investor base, and that starts potentially a run on the entire sector. So that's where we focus long and hard on. And
I do agree with that. I think that this is close to IG sector. If you look into U.S. high yield or U.S. IG, actually, European IG, there has been a great pain over the past couple of months in this sector. It has to do with the move down in equities that affects massively, has to do with our perception of the economic cycle here, and obviously that continues to push EM yields higher, especially on the hard currency side, given the correlation with US high yield and European high yield. So what we're seeing now over the past couple of months, we have seen a massive underperformance of EM Euro bonds versus EM local yields, which is quite interesting. A massive decouple of yields here, and I think it's pretty much telling you that, I mean, the credit cycle is at risk at the moment.
Gentlemen, we've got to leave it there. Christopher, nice to see you. We'll see you next year and see how some of these trades manifest. And maybe we won't talk about Brexit all yet. Well, we will, won't we? Christopher Peel, Chief Investment Officer at Tavistock Investments.